Hello, welcome. Thank you for being with us today. We're broadcasting live from Park City, Utah. And Zach, you're in New York City now, or
I'm actually in Vienna currently.
okay, so I didn't know that. Looking good in Vienna.
Thank
Thanks for
you.
being with us today. So thank you all for being here. As you know, we can't hear or see you except that we know you're there. So please feel free to post your questions in the Q&A rather than asking them live. We have a lot of folks that are going to be joining today. And so as your questions come to mind, please feel free to post them in the Q&A or the chat box, and we'll get to as many as possible. We're going to be recording this and posting it to the Family Office Insights YouTube channel and then also on Zach's website. So if you need to refresh or share it with others after you hear what you're going to hear today that might be interested in hearing more about what Zach's up to, you're most welcome to connect with him directly. We'll make sure that happens as well. So today's format is we're just going to be chatting, sort of fireside chat type of thing. I had the privilege of meeting Zach in Miami at the, I guess they call it Context Apex now, but my friends are running part of that conference. And so I was happy to come down and meet a bunch of folks. And Zach was one of them that we were really happy to have on the Luminary Series today. So with that, Zach, you want to just give us a little background and we can chat for the next half hour or so?
Yeah, sounds good. So thanks for having me on today, Arthur. Unbounded Capital is an investment firm that focuses on investing in companies solving big problems in the world that are leveraging blockchain. To date, over 99% of capital that's gone into crypto and blockchain has not gone into that. It's gone into either, crypto tokens, liquid crypto assets that, from our estimation, are in pretty much all cases, aren't really providing any value or any utility. And then companies that try to make money off people speculating on these crypto assets. So these are companies like exchanges, miners, prime brokers, notable exchanges, FTX, Coinbase, kind of prime brokery type firms, Genesis. BlockFi is kind of maybe in between a prime broker and other financial service provider. But that's been the main commonality for crypto today, which is that it's been really about crypto and how to get more people to buy the crypto, to onboard to what people call Web3. And it's kind of been divorced from actually just solving problems people have in the world. So at Unbounded today, we are still the only investment firm focused on blockchain that explicitly tries to avoid crypto. So it doesn't mean we avoid the cryptography that's important to blockchain, but we take a very different approach, investing in real companies and equity, not tokens. And excited to share more about what we do over the coming half hour or so.
Great. So just repeat the first part of that, because I think it's really a significant difference. And even though we gladly told people about how you were able to call out FTX ahead of time and so forth, I think the first thing that you said about using blockchain to do things, I can't repeat it, but so just repeat the first part because a bunch of folks just got on.
Yeah, so high level, Unbounded Capital invests in seed stage companies, not at the very beginning, but at the relative beginning of their life cycle, that are trying to solve some of the biggest problems in the world across different industries, where blockchain is a key part of their tech stack and their solution. So I think it might make sense to maybe just give an example. So one of our portfolio companies is called DXS. They leverage what today is the most scalable blockchain in the world, where the median transaction fee is 1/20,000th of a penny. So every transaction, every piece of data you put on chain costs you roughly 1/20,000th of 1 penny. So through this technology, they're able to get folks in frontier markets. Most of their customers today are in Indonesia, the Philippines, and Nigeria, to be able to invest or trade into US equities in increments as low as 1 cent. And because the transaction and infrastructure costs are just 1/20,000th of a penny, they're actually able to have over a 99% gross margin on fees for just a 1 cent trade. And their average user is, trading or investing $20 to $30 per week, but doing so at a much cheaper cost than other comparable solutions. So this is an example of a company where you don't need to, understand crypto. You don't need to be onboarded to Web3. You just need to want to have exposure to one of the most, coveted asset classes in the world, US equities, and blockchain is something that makes it possible. So that's kind of the common theme throughout the portfolio, which is that it's some type of infrastructure. And in a lot of our materials, we use the words micropayment infrastructure, because a lot of what makes a lot of the innovations with blockchain possible is that you can do these extremely small but secure and fast payments. And without that, you couldn't necessarily have each piece of data be secure. In a world where making a payment, verifying a piece of data is many cents or dollars, there's only, there's so much data that it makes sense for each piece of data to pay that amount. But in a world where it's extremely cheap to have, immutable authenticated data, and you can put 20,000 different transactions, different trades on the blockchain for literally 1 cent, it's a whole different paradigm in terms of what types of business models are possible. So we're trying to feel out which are some of these new business models that actually are going to have staying power and really have success competing against existing incumbents, and which are, likely not to, and invest in some of the best ones with the most promising business models that weren't possible until you kind of had this wildly scalable blockchain, which is just a very different approach than let's invest in the hottest cryptocurrency. Let's invest in ways that people are making money off cryptocurrency, where most of these cryptocurrencies or blockchains are so unscalable, so slow and so expensive that none of what any of my portfolio companies do is even possible.
So I'm glad you brought it up. And I knew we were going to talk about this stuff, but myself and others have heard Saylor talk about his methodology and what he's doing in investing a lot of the money into Bitcoin. And he has recently come out and said pretty much what you've said in terms of the rest. In the US, we don't have a problem, even though sometimes it's expensive to transact. But in other parts of the world, people don't have the Visa and MasterCard rails and all that kind of stuff. Is that somewhat what you're saying? Is that
I think I can't speak to what Michael Saylor has said or hasn't said.
I put that in
general,
so it could be controversial.
Okay. Yeah, in general, we have very little overlap in terms of how we see the world and how we see blockchain and Bitcoin. But I think, specifically, is blockchain perhaps more valuable in more, emerging countries and markets compared to like the United States? I think very likely. But I think there's actually robust blockchain applications, even ones that are involving these micropayments, for products and services that serve even the wealthiest people in the United States. And unlike Michael Saylor, I don't think the BTC version of Bitcoin and the popular version of Bitcoin really provides any value to anyone in the world when it comes to actually doing business. If it comes to having an asset that you can take your volatile, inflating fiat currency, put it into, and hope that it goes up, sure, it does that. But I think a lot of people that have put their money into BTC have seen it go down tremendously. So I don't think any type of volatile asset like that is really a good store of value for anyone, whether rich or poor. And then unfortunately, that version of Bitcoin is so slow and expensive that you can barely do anything on top of it. So it's not something that you've seen anyone really build on top of. You see people make money off people trading it, off people, hodling it, but you're not seeing, okay, how are people actually using this to transact with real merchants? The main example of when people tried to use that layer 2 network, the Lightning Network, on top of BTC in action mandated by the government in El Salvador, you saw a massive failure where people were literally rioting in the streets because they were against being forced as merchants to have to accept BTC in a state-owned, corporate wallet that the state could ultimately seize your assets within the wallet. So far what we've seen is nothing really, I think, of substance come out of that popular version of Bitcoin that doesn't really scale. But I think, Bitcoin, the technology, is really incredible. But that's probably, about the little that, Saylor and I will have in common, and our understanding of the technology is quite different.
Yeah. Is it fair to say that people were building things on Ethereum and the ERC20, I think it's called, or something like that, and that they realized that it was so slow and the gas fees were so high that the common perception was that it was going to be better, faster, quicker, immutable, but it really wasn't.
Yeah, I think that's very fair. So Ethereum is still by far the most, robust kind of crypto developer entrepreneurial ecosystem, the most venture capital funding, but it's today the most, inefficient way by far in the world of processing transactions of any kind. So in terms of the amount of power it takes, the amount of money it takes to do a single transaction on Ethereum, you're the worst off with Ethereum compared to anything else. There's some kind of specific things for DeFi that's like actively in contravention of a lot of the financial regulations of most countries in the world, where using Ethereum makes sense. But for real regulated business, there's no example of where I think using something like Ethereum makes sense. So there's been lots of other kind of what are called Ethereum killers within the crypto world, things that take a lot of the architecture in common with Ethereum, but add some new fancy feature. Maybe they add a layer 2 or a layer 3 network. But from our perspective, we haven't seen any of those really work out for the main fact. And I think just let's zoom out for a second, because I imagine a variety of familiarity with crypto and blockchain here on the call today. There's only one blockchain to date that has gotten cheaper over time as more people have used it. If you look at Ethereum, as more people have used the network, has it gotten 10x more expensive, 100x more expensive? No, it's gotten millions or tens of millions of times more expensive, depending on what time of the day you look at the transaction fees. Solana, hundreds of times more expensive. Polygon, thousands of times more. So you're looking at not just the fact that you go from these low transaction fees to higher transaction fees, but unit economics that don't make any sense, such that if you actually had real adoption, the blockchains would basically break down and the unit economics of businesses being built on them wouldn't work anymore.
Simply not
And that's
scalable.
correct. So yeah, I can, maybe drop this into the chat right now. We've spent a lot of our time actually doing research on all the supposedly scalable blockchains, new blockchains that haven't even come out yet that are trying to be more scalable. And that's kind of where we spend a lot of our time. And we're very comfortable not investing in businesses that aren't using scalable blockchains today, which today is, well over 99% of where all the capital in crypto and blockchain is going today.
Are you at liberty to say which one has gotten cheaper as it scaled?
Yeah, so this is the original version of Bitcoin, or Bitcoin SV. And let me actually just pull up a little graphic from our deck here on that. So this is kind of our which blockchains are scalable slide here. So if you look, the popular version of Bitcoin can do 7 transactions per second. Ethereum can do 20. PayPal can do 200. Hyperledger can do 2,700. Visa can do 24,000. Solana claims to be able to do 50,000, where it's really about 1,800, because they have a lot of these spam, what are called voting transactions. And Bitcoin SV today is in 70,000 transactions per second. So there's some, private databases masquerading as blockchains that have claimed to do more than this. Solana, Sui, Aptos have claimed to do more than this, but all of these have been in testnet environments where they haven't gotten beyond a few thousand in terms of the actual blockchain, where this kind of 70,000 is what's actually happened on chain today. And then unlike these other blockchains, it's actually getting better over time. So we're optimistic that over time, we're going to see lower and lower transaction fees. And that's what we've seen in the 3.5 years or so since my firm has been focusing on the Bitcoin SV ecosystem. What I've seen is that the transaction fee has gone from about 1/20th of a penny to 1/20,000th of a penny, a marketed decrease in transaction fees. That hasn't been true for any other blockchain. So
we could get into the weeds, but we're going to run out of time. But I've never even heard of Bitcoin SV, right? So what's that tell you?
So it's just the kind of original version of Bitcoin. If you read the Bitcoin white paper, basically, if that version just kept growing and scaling, that's what Bitcoin SV is. So without going into too much of the history, in 2017, kind of a group of more anarchist-minded developers and miners were able to kind of hijack the Bitcoin network and stop it from scaling. That's the popular version of Bitcoin that we all know today. And then Bitcoin SV is just the version that kept growing and scaling. So it's been around since Bitcoin came out. It just has gotten less investor and popular attention. But in terms of developers and entrepreneurs, it's, from our count, either the second or third most used blockchain in the world today in terms of entrepreneurs, companies on the network, developers using it.
Yeah,
So not
super.
all of our companies we've invested in are using Bitcoin SV. We actually recently invested in a completely new blockchain that we think has the potential to also be really scalable. That's much earlier stage, but a lot of them share that in common, because in terms of like a battle tested thing that's actually worked, it's grown, it's scaled, that's really the only one that we see today. And that's, one of our more, I'd say, contrarian or controversial opinions at Unbounded. But, we back it up with some serious research. We've written a book. There's, I think a lot on it where if you really care to look at this, the facts are pretty clear. But if you're primarily motivated by how do I make money off something liquid token wise, you're not going to necessarily be incentivized to look there.
Yeah. So we taunted the group with your where you were able to anticipate BlockFi, FTX, maybe Celsius, and I think I might have mentioned this. I met Alex Mashinsky at the beginning of Celsius, and a lot of his people in New York, and Alex had a history of wrangling finally winning the award of putting internet in the subway system. So he became famous and rich as a result. And I never thought that he had nefarious intent. And I'm not asking you to make a judgment in that regard, but what was it that caused you to be able to see this stuff coming more so than others?
So to be clear, we did not predict that FTX would be riddled with the degree of fraud that it was. But what we were clear on for years now, and happy to share more about this in any follow-up, that companies that are making money off the speculation of glorified Ponzi schemes are not good companies. But these companies have been some of the most bid up companies in the venture markets over the last few years. So if you look at like who's raising capital at absurd valuations, it's exchanges that I think have very little long-term staying power, because you need this constant line of suckers to keep investing, trading the crypto. And if that stops, it doesn't matter what your revenues were over the past 10 years. Coinbase, yes, it's done an incredible amount of volume, of revenue, of fees. But hey, there's a really good reason why people might stop trading and investing in these things, because they're not assets that produce any value. If that changes and the perception changes, it can go downwards very quickly and your revenues drive up. So I think really all crypto exchanges to me have been something to avoid, as well as kind of prime broker type companies, or lending and financial services companies like BlockFi and Celsius, where you're basically like, hey, give me a volatile crypto asset that we think has basically no fundamental value. We'll hold that on our books. In the case of both BlockFi and Celsius, Celsius a lot more egregiously than BlockFi, we'll lend this out with really dumb underwriting standards, and to some degree we'll obfuscate what we're doing to our depositees and our investors. And then if crypto goes down a lot, well, I guess that we tried, So there was always, if you look at just BlockFi's, without even knowing a lot, but just looking at their deck that was circulating around, you can see, okay, if BTC falls 50%, 60% in a given period of time, they're probably going to be insolvent. And this is kind of what we saw, which is that these were just ticking time bombs of kind of leverage on top of really worthless assets. So unfortunately, while these I think were some of the least desirable private companies to look at, they actually, were getting bid up with some of the most interest ever. And a lot of my fundraising and conversations with family offices, in 2020, 2021, I'd be asked like, hey, what do you think of, BlockFi at $1 billion, BlockFi at 4 billion, BlockFi at 2 billion, Kraken at 4 billion. I'm like, this is one of the worst risk rewards that I see in the venture ecosystem right now. It's just, so that's kind of what we were predicting, not necessarily that, hey, how much fraud was perpetrated at Celsius, how much fraud was perpetrated at FTX, but more like these business models don't make sense. So once you kind of add the leverage that comes from being a Silicon Valley darling, being a Wall Street kind of crypto darling and raising at high valuations, it just seemed very likely that you're going to see some type of blow up in the coming years. So it was kind of easy to write that off, I think, while those companies were getting bid up in terms of paper valuations, and while your liquid crypto assets were going up and up. And now that our firm was one of the only positive performing firms in 2022, And you can see what we've said in writing and over videos for years about this. We're seeing much more interest, I think, in some of the real value of blockchain now that a lot of people have lost a lot of money investing in this BS.
Yeah. It was kind of like, for the uninformed like me, is that sooner or later the music's going to stop and there's not enough chairs, right?
Yeah.
So let's talk a little bit about the fund. How much you're raising, what are you looking for now, what type of LPs you're looking for, and then after that, let's another example of the type of thing that you'd be comfortable investing in that you have or about to.
Great. Yeah. So we started investing into the crypto and blockchain world in 2018 with a fund. I've been doing this, near full time since early 2017 with my own personal capital. And then when the firm started officially registered with the SEC in August of 2018, it was a hybrid venture hedge fund. So at that time, I was kind of a, wide-eyed, overconfident, idealistic 25-year-old that made a ton of money arbing Bitcoin and doing other types of more liquid trading things, and thought that, crypto, the BTC, Ethereum was, God's given gift to earth, and it can only go up. And then once I, started doing this with outside capital, and I think taking more of a process-oriented approach, it became really clear to me how much BS was in the crypto world. And then, luckily in kind of early mid 2019, we radically changed the thesis to stop doing any of this liquid crypto stuff, stop investing in companies that have meaningful exposure to the liquid crypto stuff. And so our first fund, that we closed that to new LPs about a year and a half ago. And our second fund we launched last summer. It's a traditional VC fund structure. So, anyone that's been an LP in a venture fund, very similar, if not probably the same in terms of what our docs will look like. The only difference is that a lot of our companies underlying their technology will be blockchain, and specifically will be a blockchain that actually works. So this fund, we launched it, first closed with 5 million. We currently have 13 million circled. We're targeting 50 million, and our final close is June of this year. In terms of our existing LP base, it's primarily, family offices of people that have made their money in the hedge fund world and the private equity world, or kind of existing, major hedge fund managers, private equity fund managers that are just, personally investing their capital, but don't necessarily have a proper family office set up yet. And notably from that is not typical family office venture LPs or venture fund managers. And that's because, as you can tell, we're taking a pretty contrarian approach to investing in this space. And as a result, the vast majority of people that are interested in crypto or blockchain, have made investments in things that I don't think are good investments. And then it's kind of hard for them to be like, okay, well, maybe I made a mistake with this. Let me diversify with them. It's kind of easier to just be like, no, they're actually not right. It's maybe a little harder now with kind of what's happened over the last 4 to 6 months, but that's still kind of been how things have gone. And I think just like being from New York, I just think about risk. While I am a venture investor, I think about risk in a more quantitative way that's more similar to kind of folks from the hedge fund and private equity fund world. So of course, we're open to everyone. We have a few exceptions to that, but that's kind of who the LP base is right now. And yeah, we're looking for family offices to write between $500,000, $3 million checks to a venture firm that so far, and happy to share more about the performance, not in a live video setting. Anyone interested in share the deck with all those detailed financials.
Yeah, great. So what would you say about based on what you said so far, it would seem that you'd have the same feeling about the staking business, right? And
yeah, the staking is just like a abstracted layer on top of these BS tokens. So I think there's been a lot of innovative financial engineering in staking, but in terms of like what is it actually based on, that's been a lot more amorphous. But you also asked me, I'm just remembering now, to kind of share another example of a portfolio company. So yeah, and I think we'll get to all these questions in a little bit, but Bentley, for you or for anyone, if you want to get a copy of the deck, just shoot me an email at zach@unboundedcapital.com. Maybe Arthur can provide email or whatever.
Everybody who's RSVP'd will be the list will be given to Zach, and he'll communicate with
Okay.
you directly, so you guys will have an open communication.
Okay, great.
Bug just came in.
Oh wait, whoops. It looks like that only went to hosts and panelists, not to everyone.
Yeah.
I don't know if you're able to write that, Arthur.
Yeah.
Oh,
let's
maybe she
see.
got it. Okay.
Okay.
But yeah, just in terms of a portfolio company example. So this is kind of something we talked about in person, Arthur, in Miami, which was, okay, I like micropayments, I see the potential, but hey, I'm a successful investor in the United States. I don't, I pay for things in tens of dollars, hundreds of dollars, thousands of dollars. Why do I need to care about 1/10 of a penny transaction? So I think this is an example probably everyone on the call can relate to, which is, consuming different types of content. So all of us here today are probably paying somewhere between hundreds and thousands of dollars a year in subscriptions to, things like Bloomberg, the Wall Street Journal, Institutional Investor. But even, if we had $1 billion, we probably aren't subscribed to literally every single one that people might read. So both of us have, friends and colleagues that send us articles all the time. I personally read someone called Matt Levine, huge fan of his newsletter. And at the bottom, he always links to like 10 to 20 different other articles and things that's happening in the world. And I often click those and it's like, hey, I'm not subscribed to the Financial Times. So now I have the choice, and I'm usually on my phone or my iPad, I'm on my computer. I have now the choice of, spending 3 to 9 minutes of brain damage to sign up for the thing, find my credit card, put it all in, and then get charged a subscription where I don't want a subscription. I just want to read the damn article, or I don't read it. And like pretty much everyone, I decide to not read it every time. But if there was a really simple button I can click and say, hey, I'm going to pay 30 cents, 50 cents, $1, not have to give this newspaper my email, my credit card information, not give them stuff, but just have this more casual cash-like relationship with my different merchants and content creators on the internet, that would be a much better experience for me, whether I have $1 billion or $2. And it would allow for, I think, way greater ways of different types of businesses to monetize their content, their products, and their services. So we have a portfolio company today called Handcash, which is really one of the premier micropayment infrastructure companies in the world today. And they have a developer SDK that allows you to integrate micropayments into your business or application extremely cheaply. Easily, you don't have to understand crypto, understand blockchain, and then you could kind of turn that button on. And you can charge 1 cent. And because of this, Bitcoin SV blockchain we're excited about, that only costs you, less than a cent to actually pay for it and still have Handcash make money. So Handcash gets great gross margin. And now you as a merchant aren't forced to charge someone $2 or $3 to pay your, 25 cents plus 3% tax to Visa. You can pay under a cent. And we think that's just going to open up a lot. So that's an existing portfolio company of both our Fund 1 and our Fund 2. So any LPs would have exposure to that company by working with us. I think looks like we got a lot of questions piled up here, Arthur.
That's kind of a good thing, huh?
Yeah, I would say so.
So
you want me to start from the...
Well, I'd like you to do that simply because we're going to run out of time. So if you can burn through them real quick, but you're going to get them. If we don't get to all of them, you go get a copy of the chat. But why don't you just knock them out if you want?
Sounds good. So Tim, your first question, what's the new chain you invested in that you're bullish on? This is a private company that is not gone live. It's not going to go live soon. So I'd be happy to talk to you about that on a future call, but I couldn't share that right now for something that's going to go on YouTube. But if you like what you heard and you want to learn more generally, happy to chat more about that new blockchain. I'm sure, either way, you're going to hear about it in, 2 to 6 months time. From Bentley Wilson. So you would recommend not investing in blockchain companies that are using ETH. And yeah, let me just kind of expand upon this for a little bit. So it's not like that there aren't incredible entrepreneurs and great business ideas that are built on top of Ethereum. It's that if they're actually successful, their business fails. So one of the canonical examples of this is something called CryptoKitties. So in kind of that crazy, ICO crypto boom of 2017, this CryptoKitties game got really popular and broke the Ethereum blockchain and made it so the transaction fees for a period, were thousands of dollars, 10 plus 10,000 even for a little bit. And then they realized, wow, we built this great game. It got a good amount of adoption. Nothing, nothing compared to like what you'd think of as a hockey stick for a normal tech company, but pretty good for, kind of the crypto world, and the business stopped working, because you can't have a successful business if you're charging someone, even hundreds of dollars for a, JPEG of a cat, if it costs you thousands of dollars to buy the cat.
Yeah.
So that company ended up building the Flow blockchain. It's called Dapper Labs, and it's, been the Silicon Valley darling that is, raised at a multi-billion-dollar valuation since then. And, I think that the Flow blockchain is one of the more promising blockchains that hasn't really figured out scale yet. So that's kind of a longer conversation when we think about Flow. But yeah, there's countless businesses that basically launch on Ethereum, are really excited because of the developer community and, ETH being a highly priced crypto asset. And then when they actually, decide to, hey, now it's time for me to scale up, well, guess what? Your business breaks. So now we've seen that happen enough such that you don't have to necessarily learn firsthand. Smart entrepreneurs that are doing their research and due diligence ahead of time are realizing that, hey, actually, we're just not going to build on Ethereum at all. We're going to look into other things. So it used to be kind of back then, we saw folks move primarily to like Hyperledger and BSV. Now we've seen kind of Hyperledger really go down. IBM's pushing it less. People moving over much more to things like Solana and, Polygon outside of BSV, but of course still BSV itself. And something that might be helpful, Bentley, I just put this in the chat. This is an article about someone that built a business that, raised millions of dollars in funding, had a successful game, started on Ethereum, and then they realized it didn't work and didn't scale. So they did a really deep dive into all the different blockchains and decided what to build on, and ended up moving over to Bitcoin SV. So for kind of understanding what a more technical entrepreneur, what a more technical entrepreneur decided and what their thought process was, because I could tell you, how people move over, but I think better to just, read that 15-20 minute article from the source of like, here's why they decided and here's kind of how easy it was. And since then, there's been these compiler tools that allow you to actually just take the exact code from an Ethereum smart contract and move it over to Bitcoin SV with just kind of one, click of a button. So
you can port it over. That's super cool.
Yeah, but again, I think there's not a ton in common between the canonical types of crypto projects and what we're seeing in BSV. The vast majority of crypto projects, a big part of the value proposition is being extra legal. So like DeFi is really just a euphemism for finance that exists outside of existing regulatory frameworks. So I have my own personal political,
I love it.
what I want to see in the world. That's why I got into crypto. But after I, raised a fund and realized I had to make money, it's not just about, okay, do I want this financial system to exist outside of the SEC? It's understanding the reality that it doesn't. And we can't just, keep putting our ears and our fingers in our ears and hope that crypto is this like thing that's outside of the rule of law. It's not. And if you think it's likely that government will be able to regulate it in very similar ways to the existing financial infrastructure, a lot of these companies or projects really, in more cases that are built on the Ethereums and the Polygons in the world, start to crumble.
Yeah, and look what happened to Kraken, right? Right or wrong, they had to bounce out, and then the bank in Wyoming didn't get approval, but they want to continue to get approval. It's interesting to see how the regulators, which we don't expect to do smart things and take their time, but on the other hand, those of us who feel comfortable in knowing that if it's regulated, at least there's, we're not going to go to jail, right?
Yes.
I mean, that's really what it comes down to, right?
Yeah.
Just an editorial, but you want to knock out a couple more?
Yeah. So Tim, appreciate all the questions here. So RE Bitcoin SV, what is the chain sacrificing in the trilemma? So just to explain what Tim is referencing, I think there's a big misconception about the value of crypto and blockchain, that you basically can only have two of the three: decentralization, kind of scale. Maybe let me pull up a graphic for this. It might make it a little easier. Do I have one in my deck? Okay, bear with me. Okay. Okay, So there's this, I think, misconception that basically decentralization, scalability, and security are all really valuable, and any blockchain can only have two of these things. So in some sense, Bitcoin SV, the original version of Bitcoin, is extremely decentralized in how the architecture of different blocks and the blockchain works. And then in terms of, is the mining power of people that are facilitating transactions on the network decentralized? It's similarly decentralized to the BTC version of Bitcoin in terms of who's actually mining the thing. But I think generally speaking, people don't care about kind of the more technical means of decentralization. They care about, decentralization as, hey, if governments try to regulate this, if governments try to tamper with or amend the blockchain, could you resist that? Could you stop that? So really decentralization, I think, is helpful to understand. It's typically a euphemism for extra legal or illegal activity. And a lot of the design choices that have been made in the crypto and blockchain world have been about, hey, let's say governments try to seize assets directly on chain. Let's say the police try to, understand who's behind this wallet. How can we illegally resist that best? And that's kind of what has been focused on with the Ethereum network, with the BTC version of Bitcoin, with most blockchains. It hasn't been trying to get two of these three. It's been basically all decentralization and maybe a little security with no scalability. So what we argue at Unbounded Capital is that most of the ways people privilege decentralization as a value doesn't actually really exist. And that what you want is really more of a distributed network rather than a decentralized network. And that it's, silly and futile to go against what the biggest governments in the world, have as their laws and regulations. So Tim, I would refer you in terms of, more information on that. We wrote a book about 2.5 years ago, and we've made a couple updates since then. But in this book, what we do is we take 10 of kind of the biggest, I'd say, like assumptions and theses of what we call the crypto consensus, what most people are excited about with crypto, what the multi-coins, Andreessen Horowitz's, Union Square Ventures, kind of how they think about the value of crypto. And we try to steelman that as effectively as possible. And then we put that side by side with how we think the value of crypto and blockchain and where that comes from and why. And in this book, chapter 4, we kind of get into this decentralization, I think, trilemma misconception. And I just kind of pasted a link for that there, and happy to talk more about it further. So for David
we can socialize
Gorman,
the book. Would you recommend, is the book updated enough that
yes,
it would get your current thesis?
100%. Yeah.
Okay. Yeah.
I think the book is our single best resource to dive in deeply to how we think about the crypto and blockchain world.
Yeah.
So again, a book isn't for everyone. It's, I've read an audiobook version of it as well. Comes out at about 3.5 hours. So not particularly long, but not short. But if you're going to try to put that time into really understanding some of these views, I think better than any of our webinars, of our letters, this is kind of where we've put the most time and thought into.
Yeah, that's beautiful.
So David, we have, what is your exit time frame, given that the market seems to be clustered in the speculative? So I hope kind of, since that question has been asked, you understand that what we're investing in has very little overlap with the crypto world or even what's considered the blockchain world. We're investing in what are largely infrastructure companies in fintech, gaming, supply chain, data infrastructure that use blockchain as part of their tech stack, and are really more similar to just like a great seed stage company that doesn't use blockchain whatsoever. So given we're a seed stage venture firm, our fund is set up as a 10-year fund. So I'd say anyone that we're looking to work with is a long-term oriented investor that has likely had exposure to early stage venture capital before, understands, while there's very significant upside that could come from that, so far, I think in our first fund, we've kind of shown good evidence of making some good bets here. It still takes many years to actually have that become cash liquidity. And happy to talk about some of those details more further on a call, David. Looks like it might be the last one here. Again, from Tim, you mentioned you don't invest in tokens. To what extent do you support your portfolio company's issuance of tokens? How do tokens factor into your thesis? So I'd say, generally speaking, really more than generally, with basically a small single-digit amount of examples that I can think of, having been in the space for many years now, almost every creation of a token when there's kind of a new company or new idea is really just a money grab, especially when there's an actual equity company and a token attached to it. And the reason for doing the token is to raise capital more easily for your business and really to get more liquid capital for yourself personally. So traditionally, you know, with equity investing, while it's maybe changed a little bit over the last few years, at least before kind of the bubble burst, what you saw was that if you start a company, your net worth is basically completely tied up into that company until you have your acquisition, your IPO, your SPAC, your direct listing. But with, you know, a crypto company or a project, now there's a million examples of people having an idea, selling the idea, and then cashing out 10, 20, $50 million within a year or two. So of course, crypto attracted some of the most short-term oriented kind of zero and negative sum entrepreneurs and investors to the space that saw, you know, literally, I mean, if you invested early into Bitcoin, invested early into Ethereum, even if you held all the way, you know, held till now, sold at the top, you had the highest returns in investing history, bar none. So that attracted a lot of people that were trying to make money fast without really thinking about, okay, is this sustainable? What made it so that BTC went up 10,000 times? Is that repeatable and why? It was no, just, hey, people made a lot of money. I want to make a lot of money. Let's kind of do this. And, you know, so in terms of how this affects our thesis, you know, are there some portfolio companies of ours that have tokens? Yes. Will there be future portfolio companies of ours that perhaps make tokens we're not aware of or haven't discussed right now? Probably. But I think the difference is, you know, they're going to manage that and understand the inherent conflict of interest. And they'll have their tokens structured much more like an equity investment or just be kind of a pure utility token that isn't really an investment vehicle if they have a token. So if you have a utility token where it's not supposed to go up and it's just used to make your game or application or business easier to operate, sure, that could make sense. We see very few of those, but there are some examples I can think of. But really, there's often just a huge conflict of interest between, hey, I have a token and I have equity. Equity, I have to build a real business and like get underwritten by real venture capitalists, by real Wall Street if I want to make my $50 million. But if I have a token and I sell a great story, well, I can make 3 million in a year or two. So when you have the option of pumping the token and selling the story versus building the business, you know, incentives always win, regardless of how well-intentioned a lot of these, you know, entrepreneurs and investors are. And I think you see this, you know, with like the Helium. So this is, you know, considered one of the big successes of the crypto world, this Helium token, this Helium company. But if you look at it, over 99% of their revenue has basically come from selling this, you know, utility token of theirs and making money off the selling of this token and people getting started with the Helium ecosystem. It's not actually companies paying for the, you know, distributed broadband or 3G or 5G network. It's coming from kind of this whole token closed ecosystem. So that's not sustainable. And I think, you know, the team has obviously executed incredibly there. But if they didn't have this token, how much better might they have executed on the actual infrastructure side of their real business? Probably a lot better. So it's very rare for us to kind of see, again, with this new blockchain that maybe we'll talk about offline, Tim, I think having a token for that can make a lot more sense if it's literally a new blockchain. But outside of that, for like a normal business, having your own token typically degrades the user experience and creates a big conflict of interest. So I know this is kind of a long-winded way of saying, basically, stay away from tokens. We don't invest in tokens. But I think it's important to understand why, because a lot of folks are just like, oh, I don't touch tokens. Where for us, it's really, we were really excited about tokens. You know, I made my initial money in the space investing in tokens. I thought they had a lot of
one would
potential.
argue you wouldn't be having this conversation had you not done that first, which doesn't mean
I would
that's
not
a bad
argue with
thing.
them.
Yeah,
Yeah,
right.
I would not argue with them.
Super. This is very helpful. And I know the group's enjoyed it, and so have I. So thank you for doing it. We do have to run. If you want, we can do it again sometime. We'll see what happens. I'm sorry, I'm gonna have to throw everybody off because I have to go. So Zach, thank you. Thank you for doing this. And as I said, we'll get the recording to you. You can post it where you want. We'll make sure we lead everybody there. And then we'll put you in touch with everybody that RSVP'd, and super appreciate it and love to have you back.
Yeah. Thank you for your time today, Arthur, you know, Tim, Bentley, David, thanks for the questions and thanks for joining everyone.
Yeah. And a bunch of those people you just mentioned, I happen to know. So
Great.
they're good guys. So, and as I always say, folks, thank you for sharing with us the only thing you can't make more of, and that's your time. Till next time. Thank you.
Yes.
Take care. Thanks, Zach. We'll talk.
Yes. Bye.